Welcome to Disruptive Capitalists, the show where purpose-driven entrepreneurs and bold investors share how they're reshaping the world by investing time and money in a way that improves lives and creates wealth. So let's get to it. Thank you, everyone, for joining us today for another episode of The Disruptive Capitalist, where we talk about making a difference with our time and money in a way that creates wealth and helps other people. So today, my guest is Ben Carmona, who is a 1031 expert. And Ben, thanks for joining the show.
Yes, absolutely. Thank you, Sam. Great to be here. Look forward to chatting with you and your audience.
If you would, please explain a little bit about who you are and how you got to be where you are.
Sure, absolutely. So, well, first, I'm based in Orange County, California. I'm a financial advisor. So I'm securities licensed. But I'm not your traditional financial advisor that's doing stocks and bonds and mutual funds and annuities and insurance. I've spent my entire career in private real estate syndications, broadly speaking, alternative investments, if you will. So I work with accredited and/or high net worth clients, and they come to me and our firm to help them with 1031 exchanges, which I'll go into, and then also other non-traditional or alternative investments that provide, income, growth, and other tax mitigation strategies.
Thank you. We've talked before. We've gone into some pretty depth about 1031 exchanges. For the audience who may not be as familiar with what a 1031 exchange is, can you cover just a little bit about what it is and then why it's so powerful?
Absolutely. So IRS code or Internal Revenue Code 1031 is arguably the most powerful tax mitigation or wealth building code within the tax code. It's been around for over 100 years. And essentially for investment property owners, right? Real estate investment property owners, the IRS allows you to defer paying capital gains taxes on the sale of your investment property as long as you exchange the proceeds from that investment property to buy other investment property. If you're loosely familiar with 1031 exchanges, you've heard the word like kind, right? As long as you sell investment property, you buy investment property, you can qualify for this 1031 exchange and defer taxes. And just to take it one step farther, if you sell a multifamily project, you can buy an industrial deal. If you sell raw land, you can buy a rental house. So it's like kind or investment property for investment property. And as we talk, Sam, just drawing a quick picture, Sam, if you bought a home 5 years ago for $1 million, now 5 years later, it's $3 million. You sell that property today. If you don't do an exchange, you're going to have a big tax bill, right? You're going to walk away with, probably 500,000 or more less in income. Or you can defer the taxes and trade up, right? And so that's the premise of the exchange. And the last thing I'll say is, you exchange, or another term is you swap until you drop. So what happens is investors can exchange and defer, or swap and defer. And then far down the road, you pass away and all the taxes that you've deferred over all these years, they go away. You get a stepped up in cost basis and your beneficiaries inherit those assets. And that's why it's so powerful. And that's why so many wealthy investors today are in real estate.
So in that investment, let's say, that $1 million example, they bought a rental house for $1 million. They sell it for $3 million. There's $2 million of profit. That's going to get 1031 exchanged under the rules of timing into another project, like kind, residential or other real estate. And then the cash flow from that project, they can keep in their pocket, correct?
Absolutely, the cash flow. But let me just make sure we're on the same page. If you bought the property, Sam, for $1 million, it appreciated to $3 million. When you sell it, you need to buy property of equal or greater value. So you need to buy property of $3 million or more. So what I thought you heard is you can't take the money off the million that you put in initially. You can't just take that off the table. That's got to go with it.
Yeah.
If that makes sense. But yeah, that's the goal, right? You started with $1 million, you're getting your income, hopefully. You exchange up, you're getting more income and more real estate, and so on and so forth.
Yeah. Brilliant. Brilliant. So why do people not do that?
Yeah, well, that's a good question. I mean, I would say unless some investors want the capital, or they're just happy paying tax. Of course, you can do that if you need the liquidity, which makes sense. And then there's another bucket of folks that just don't understand it, and they don't even know it's available. And then I would say another tranche of investors, maybe they're not able to satisfy the 1031 exchange. So we talked broadly about what it is and how powerful it could be. But the IRS has blessed us with this ability to avoid taxes or defer taxes, but they don't make it easy, right? They don't make it easy. And just touching on those guidelines real quick, the day you close escrow on the sale of your property and you intend to do a 1031 exchange, you have 45 days, calendar days, not business days, calendar days, to identify suitable replacement properties, right? And within that 45-day period of time, you can change your identification to the properties that you think you're going to go into as many times as you want. But once that day lapses, that 45th day passes, whatever you've identified, those are the only options you have. And 45 days may sound like a lot of time, but it's really not, especially for most people, unless real estate's your primary trade and practice. And even for those that it is your primary trade and practice, 45 days isn't a lot. A lot of things need to come together during that time, right? I mean, you gotta source, find suitable properties that you like. You got to do your underwriting, your due diligence. Some are going to work out, some aren't going to work out. If you have debt to replace or you have to get another mortgage, you got to lock up financing through the bank. So it's not easy, and so in those cases, it's not uncommon for folks to blow their exchange. And that's one of the ways we can come in and help. And I don't know if that's a good pivot to the Delaware Statutory Trust, Sam, but
yeah. Before we get to DSTs, I guess there's two types of DSTs, but before we get to Delaware Statutory Trust, when should a client who's considering or has this problem, they're going to sell, they're going to have a bunch of cash, they don't want to pay a ridiculous amount of money to the feds, when should a client come to you?
Sure, that's a great question. We talk to investors in all different points of the timeline, if you will. I mean, folks, I'm talking and educating about 1031s and what the investment products that we have 2 years prior to them thinking they're going to sell, right? Up to I'll probably get a call today from somebody that's on day 40. They're panicked. They got referred in. And they're like, what do I do? I'm facing a $1 million or $500,000 or $200,000 tax bill. What can I do? Can you help me? And yes, we can. So all different junctures.
Awesome. Okay, great. So let's talk about Delaware Statutory Trust, those DSTs versus Deferred Sales Trust, which is a different type of DSTs.
We can talk about both. But yeah, it's funny, those acronyms. I think it was strategic on the Deferred Sales Trust side to blend.
Yeah.
So look, we talk 1031 exchanges broadly speaking, right? It's an IRS code out there. And then there's different ways to satisfy a 1031 exchange. The traditional and still the most common and well-known way is just simply if Sam sells his property, Sam's going to either on his own or through a broker, you're going to find another direct piece of property, you're going to buy it. Done. Then there's other structures that are available in the market, and these are widely unknown. But they're absolutely above board and legit. They're also in the code. One of which is the Delaware Statutory Trust. And I'll just start, high level, and we'll get into it. So it's Delaware Statutory Trust. It's a trust. It's an entity that's conducive for 1031 exchanges. It was created in the 80s, and it wasn't set up for 1031 purposes at that time. Excuse me 1 second. But it's a trust whereby you have one trustee that manages the trust on behalf of up to 499 beneficial owners. So when you take this trust and you wrap it around real estate, it creates a situation where you fractionalize ownership, right? You have a lot of investors owning one piece of property, and it's still considered real property ownership and therefore eligible. In 2004, the IRS came out and validated this structure under IRS code 2004-86. So you can look it up. And so they validated it from a 1031 perspective. So now I'm gonna, well, I'll stop, take a pause there before I give you an example of like what they are. Does that make sense though, Sam, on the structure?
Perfect. Yep.
So
we might want to get into a little bit of that structure. Like for example, as a because you were a syndication before and investors were coming in to a syndication, but if they come in via 1031, it looks and acts different. But we can get to that here in a minute.
Okay. Yeah. So in my world, in this DST world, there are sponsors, we'll call them, but they're the syndicators. It's like Sam, right? You're a syndicator, you're doing your deals. There's syndicators out there. And I'm going to make some big ones for the audience so that hopefully they recognize, but it's Cantor Fitzgerald, Ares, Apollo, Invesco, Starwood. I mean, there's 50 of these sponsors in this space, right? And there's some big boys. So it's legitimate. There's a lot of business being done here. But take one of those sponsors. We'll just use Cantor Fitzgerald. Cantor Fitzgerald, they go out, they buy $100 million multifamily, brand new Class A multifamily project in Dallas, Texas, right? They buy it, it's 98% occupied, fully stabilized, it's income producing. They turn around and they offer interest, 1031 eligible ownership interest into this project, right? So Sam, you sell your property for $1 million. You could go into that and you would be a 1% undivided owner in this $100 million trust, which owns the real estate. And for you, it's a very simple way to satisfy your exchange, right? Because that property has already been acquired, it's stabilized, it's income producing. And then Cantor Fitzgerald, they're the syndicator, the sponsor, they're going to be paying you monthly, cutting you checks for monthly distributions. They're going to be sending out quarterly performance reports. They're going to send you your year-end tax report that you can hand to your CPA. They're going to hire the third-party property manager. So it is a turnkey, passive 1031 exchange solution. Now, for you, you're young, you're still moving and shaking, you're making, but our clientele, right, are 60s, 70s, 80s, 90s. These folks have worked their tails off all their lives to accumulate real estate, manage that real estate. And I'll tell you, there are so many of them today that are over active management, right? They don't want one more call from any tenant. They don't want, toilets, tenants, trash, termites, whatever. They don't want to deal with it anymore. And they don't know what to do because they may be familiar with a 1030, a traditional exchange where, oh, look, I could sell my property, but what is that going to do for me? I have to buy another one. And I still have to manage that one. So why would I sell? And so I kind of pivoted off. But so it's a totally passive deal. Now going back to the 499 beneficial owners, right? That makes, given the amount of owners you can have, the minimums are low. I mean, call it 100 to 250,000 a piece. So going back to you, Sam, you got $1 million. You don't know what to do with it. You're tired of active management. Even as a young guy, you're over it. And so you could put the $1 million in this one multifamily in Dallas, Texas, or you could put 250 in Dallas, Texas. You could put 250,000 into a medical office campus in Orlando, Florida. That's sponsored by Starwood. 250,000 into oil and gas mineral rights in the Permian Basin. 250,000 into self-storage portfolio in Raleigh, North Carolina. So you have options. And I'll take a pause right after this. So it's a turnkey strategy that eliminates the risk of not satisfying your exchange, removes the active management aspect of real estate for those that are no longer interested. It gives you monthly income stream. More times than not, it's going to be higher than what you're earning today if you've owned a property for a long time. And you have access to institutional quality real estate managed by big, well-known companies.
It's beautiful. It's a beautiful strategy, because if you don't use the Delaware Statutory Trust, you end up having to roll all your money into a single deal.
More times than not, yeah.
Which is risky. I mean, you have absolute risk on one project. That market goes down.
Yes.
You're toast. But spreading it across multiple projects is great.
Right.
Can you use a DST to invest in a fund, or does it have to be in a TIC, tenants in common agreement, or other thing? If you're rolling the money out into a Delaware Statutory Trust, and then from there into the next thing.
Right. So if I heard this correctly, if you said you could invest cash into a DST, I wouldn't advise it. Frankly, like, investors come to me all the time. They love their DSTs. Ben, I got an extra few $100,000. Can I put it in this deal? Yes, you could, but I'm not going to let you, because there are better alternatives. I only say that because I'd rather put that money into a fund, as you're saying, maybe your fund. You get typically higher income, there are lower fees, more diversification. But yes, they're cash eligible. In terms of, I think what you said, Sam, is, so let's just say you invest in this multifamily in Texas. 5 years down the road, and we have to talk about the downside of these two. Don't let me forget that. 5 years down the road, it sells, right? Let's just say it sells for 120 million. You get your $1 million back, and you get your pro rata share, in this case 1% of the 20 million, 200,000, and you're back in an exchange situation where you have all options on the table. You may say, hey, wow, that's great. I love this deal. I'm going to go back into a DST, or I'm back in the game. I want to go buy direct real estate again, or you can cash out, pay tax. So it's a strategy that is not once you decide, you're not stuck there forever, if you will.
Gotcha.
Did that answer your question?
Yes. There's a lot of talk. I go to these alternative investment conferences, and what we're talking about is alternatives. And most people don't consider real estate as an alternative unless you're in the investment world, and then real estate is an alternative. Can you explain what I'm talking about?
Yeah. So alternative investment, and they're becoming more mainstream now, and I'll give you some background on that. But essentially, the definition is anything that is atypical from your traditional portfolio, which is going to be your stocks and bonds and mutual funds and annuities, right? That's what everybody knows. That's what everybody's financial advisors have been, operating since the beginning of time. And so alternative investments are anything outside of the stock and bond kind of portfolio, right? And most of them tend to be private, debt funds, or private equity, private real estate funds. It could be a portfolio of, manufactured housing communities, or again, oil and gas mineral rights, or government subsidy housing or tax credits. There's this whole world of investments that most people, by and large, have no idea even exist, right? And as I was telling you, Sam, and this is why I've been in this business for 20 years, and this is the only space that I've lived in. But if you go back to 2009 or 8, whenever the market crashed, my parents, baby boomers, seniors that did everything right. They saved their money. They had liquid cash. They followed their advisor's advice of doing 60% stocks, 40% bonds. They had real estate. They had low leverage, whatever. And then in 2008 hit, and they got hammered. Everybody got hammered. And they're like, wow, I did everything right. And here I am crushed. Later in the later years of my life, I don't know if I'm going to be able to climb out of this. And I remember, we lived through it. My parents went through it. And then, if you stop and you take a look, okay, well, if we did everything right, and we still got hammered. Who did well? And you look under the hood, and it's, of course, the big boys, the institutions, the pensions.
Yeah.
And you go, okay, well, how did these guys do well? And if you dig in, they had 30, 40, 50% of their portfolios in alternative investments, right? Deals that aren't tied to the stock market, deals that, frankly, prevent an investor, an emotional investor, from selling at the wrong time and buying at the wrong time, right? They're in income producing stuff. And so I bring that, hopefully that tells a story. And here we are, I can't even believe it. What is it? 17 years later, 2025. We've come back for the most part, right? Investors have come back from the doldrums 17 years ago, but there's a lot of uncertainty. It looks like, unfortunately, there could be a war breaking out. We had inflation. It's a hot mess out there, right?
Yeah.
And how does an investor mitigate risk and avoid another 2008? I would argue, and then I'll stop after this, Sam, every investor should have a portion of their portfolio in alternative investments, something private, not tied to the stock market, that can provide more income, lower your volatility, and increase your diversification.
Tony Robbins just talked about this in his book that came out, I think it was last year, The Holy Grail of Investing. And what he talked about was, having those investments in 7 key areas and away from the stock market. Stock market should be an investment tool in your portfolio, but when the stock market goes, it goes big and hard, and in either direction, right? You can lose it all in a minute, or and it's all investor sentiment. It's not based on
Absolutely.
It's just an emotional roller coaster. Yeah,
exactly. It's not reality. It's you're exactly
not
right.
reality. And so one of the things he talked about was, he did talk a little bit about 1031s, but another thing he talked about was alternatives being a great place. And then he talked about he himself invests in funds and alternatives and co-GP stakes funds, which is what we were talking about before we hopped on this call.
Sure.
It's interesting to see more and more people talk about alternatives, like real estate, oil and gas, other things. Tokens now, of course, is a big one.
Right.
That one is certainly 90% hype, 10% product.
Yeah, exactly.
But that's
yeah.
You get in early, you're great. If you get in late, you're
Yep. There's a lot of moving. The market is shifting so much with AI and Bitcoin and blockchain and tokenization, and there's so much, and it's important that you just have a balanced portfolio, right? You may not look. I don't even understand Bitcoin all that well, but I have a position just in case. You know what I mean?
Yeah. I mean, that's diversification. That's looking, and Buffett always says you should really understand what you're investing in and so forth. But the number one thing that's helped Buffett make all of his money was 70 years of investing, or 80 years of investing. I don't know how many it is now, but time with money out there invested is the biggest key indicator of whether or not you're going to do well. So there's not a lot of people who are as knowledgeable as you are about 1031s. What's your ideal client? Who are you looking for?
Yeah, and I didn't really tell you much. I did fail to answer your first question. I'll come back to that. But again, our prototypical clients are baby boomers and seniors, right? Again, 60, 70, 80 and up, that, again, have worked their whole life to build what they have today. They don't want to deal with the management headaches. And most of our investors, they don't even know this, but the properties that they've owned for 30 years, they're earning 1 to 3% income based on values today, right? They may be getting 15% 30 years ago. Well, today they're getting 1.3, so they're earning very little. And then those same clients have fully depreciated their real estate, so they're not even sheltering any of the small 1 to 3 that they're getting. So those are our clients that are looking to get out of active management, exchange, mitigate risk, protect their portfolio, increase their income. And then also a big thing is from an estate planning. Think about a client or our client that had, or if you, Sam, have 3 kids, 4 kids, you have 1 property, right? When you pass direct ownership, 3 of your kids may want to keep it. One of them may need the money, wants to sell it. That's a recipe for disaster, right? And it's sad to see. I see this stuff every day.
Happens all the time. Yeah.
With the DSTs, that happens automatically. If you invest in a trust and your trust says, hey, I'm giving 20% to this kid, 20% here, 20% here, and then you like the 4th one the most, 40% here, upon death, those interests are allocated. So when the DST sells, the kids can walk away scot-free with the cash and stuff with base. But those are our clients. And I'll take one more second, then I'll stop. My background, so I said I've been here for 20 years. Prior to starting Perch Wealth 5 years ago, and I have a business partner, and we also have 10 advisors on our team throughout the country.
Yeah.
I spent 15 years on the syndication sponsor side of this business. So I was acquiring the real estate and doing the underwriting and due diligence and structuring all sorts of private vehicles, including Delaware Statutory Trusts and tenant in common and REITs and BDCs, all sorts of stuff. So I'm intimately familiar with the space. And that's, so we're out here helping our parents, your parents, my parents, their friends, protect their hard-earned money and not get into the wrong deals.
It's easy to get lured into the wrong deals because decks are shiny, people are positive,
returns look good,
appetizing. Says that the guy went to Wharton, so clearly they know what they're doing,
Yeah, exactly.
Yeah, or Harvard, and like, oh my goodness, I'm in.
Yeah.
And then your money goes poof.
Yeah.
So, Ben, thank you so much for being on the call today. Just really appreciate your wisdom and your thought and doing everything you can to help your clients out. Protect their wealth, grow their wealth, and pass that on to generations. And, thank you for doing that.
Absolutely. My pleasure. I appreciate being on. I've enjoyed speaking to you, and I'll just, if it's okay, our website.
Yeah, absolutely. Last words are yours. And if you would let people know how to reach you.
Yeah. So you can go to our website, perchwealth.com, PERCH wealth.com. And then I'll give you my cell phone number, and I will always call you back. It may take a minute, but 818-269-4972. So go to our website. We have great advisors, or call me, and we're happy to speak to you, educate you. That's what we pride ourselves on, is education, not selling anything.
Awesome. Thank you so much, Ben, and we'll see you next time.
Thank you, sir. Have a great day.
If this episode shifted your thinking, then share it with someone bold. And remember, capital is a tool. Use it to build a world yours.